Hey guys, Greg Siltman here, CPA in Alpharetta, Georgia, and now Swanee, Georgia, as the empire expands. Very good. We've been doing some series of videos on Rob's rollover, which is essentially a mechanism, a capital mechanism of accessing your 401k early without having any penalties and investing that in a C corporation, which is a company which you will own and manage and may use to buy subsequent companies. So quite a popular structure as I've come to learn it, as we are now in the SMB, small and middle-sized business shake-up, takeover, rollover, I don't know what you can call it, as that demographic shift we've all been hearing about finally does actually come down to bear, but obviously not in the ways that we all expected it initially. Anyway, what follows here is our second to last video on the Rob's rollover with a bit of a twist, in that many people ask me, when I use a Rob's rollover, does my 401k have to own 100% of the C corporation? And the answer is no, it does not. It can be owned by other entities, taxable entities that you own, or other retirement plans. And so I'm going to get into that in the video if you just stick around for a little bit more. Okay, welcome back, folks. We are discussing here the Rob's rollover plan with a little twist, a twist of lime, if you will. Okay, so what we're seeing here on the slide is the benefits that I'm going to allude to you as to how those come about, right, and why they will benefit. You'll recall that the Rob's rollover is essentially using 401k proceeds to create a new 401k rollover plan, which is used to invest in a C corporation, which you own and which you manage, and you buy a business through that, an operating business through that. So that was the Rob's rollover. The twist with the Rob's rollover is that you can also introduce the 401k rollover plan can say own 80% of the C corp. The other 20% can be owned by another owner. And in this case, the other 20% is going to be owned by your Roth IRA. Okay, let me tell you why this all works. So real quickly, remember you had the Rob's rollover and the 401k plan. Comes out to you as required minimum distributions, RMDs, as you withdraw it out and becomes taxable. The other 20, which is now grown to 200,000, is essentially tax-free, which is the benefits of the Roth IRA, that money, any growth in funds in a Roth are tax-free. So you've essentially shielded yourself from $180,000 worth of capital gain. So that's the mechanism that we're talking about here, the 80-20 split. So it's called the Rainmaker Advantage Plan, not my name, not my product. I don't endorse them. It's through Better Trends. Okay, so this slide really just represents now all the benefits you get out of having the 80-20 rule. 80-20 rule, get it? So the Rainmaker Advantage Plan is not my product. It is something that's built by a company called Better Trends. I do not have a relationship with them, and I don't earn any money by referring them, but they've got a good structure. Corporate capitalization strategy that allows business owners to use funds from qualified retirement plans we've established that to start a business. So what is the benefit of the 80-20 rule? Let's go. I'll start with the top right. No mandatory distributions. Unlike traditional retirement plans, REP does not require mandatory distributions at age 72. Okay, yada, yada. Why is that? Because a Roth IRA doesn't have mandatory RMDs. That's pretty much it. Double your legacy. REP can effectively double your net worth transferred to your heirs by shielding assets from tax liabilities. Yes, I've explained it in a bit larger detail a little bit earlier, but that's how it's done through the Roth. You're shielding capital gains tax to a degree. Top left, lifelong wealth protection ensures wealth protection for your spouse and future generations, reducing or eliminating tax impacts, maintaining higher Medicare premiums. Okay, the Medicare premiums, I assume that your overall income remains lower. Not sure about the medical premiums. Maybe one of you guys can advise me on that, but obviously you are protecting wealth, right? You're shielding assets from tax liabilities, which is ultimately protecting wealth. Tax-free wealth transfer through REP, 100% of the gain on the sale of the company can be passed to heirs without estate or inheritance tax. Okay, well, that's true because of the step-up basis. When the person passes away, the Roth IRA gets a step up, or the assets inside it get a step up to the heirs. so it avoids inheritance tax. So, well, there you go. That's the wrap shield, So a good little structure, a little bit nuanced to the traditional Rob's rollover, but it definitely has its benefits. Hope you all enjoyed that. And if you want to know more about us, check us out in the links below. Or if you're interested in taking the next step with the Rob's rollover, give me a buzz. I can help you out. I know a guy. Take care. Out.